Hello there. Welcome to Learning Finance with Anish Shankar. My name is Anish Shankar and I am a cost and management accountant based in Kochi, India. I use this channel to kind of drop videos about ideas and concepts related to financial management. And today we are looking at a concept called capital budgeting. So this is a very important and interesting topic that helps essentially finance managers to decide which projects that they should promote or invest in that will help the company grow. So growth is always a big thing for most companies today. Everyone wants to know what is the growth trajectory, and with limited resources, with competitors gaining on you every second, it's important that you choose the right projects that will deliver the most stakeholder value. It's also important to understand that most expansion projects or new projects are capital intensive. If you make a decision to invest in something, it might run into crores and it might go multiple years. So if you end up trapped midway, where you realize it's the wrong project, then you spend tons of money, you locked your capital in the project, but if you don't think it'll generate value, and you're stuck. So it's important to ensure that these long-term investments are evaluated using time-tested metrics and the right project is selected, that which will create value to shareholders. So that is really what capital budgeting is, and for that we need to make sure of something before we get into capital budgeting. That is, till now, if you're studying accounts, usually we focus on profit, right? That is really what we kind of focus on from a basic accounting perspective. Even we do have fund flow, cash flow, but it's one of the minor statements that you add onto the financial statements, the balance sheet, and the profit and loss. But here, cash flow really becomes the primary factor. It is king. Cash is king here. What is cash flow? It's the actual movement of money in and out of the business. So we do not follow the accrual concept. Essentially, any cash is recognized only when it comes in, the year that it comes in, and when it goes out. So why do we use cash flow? Because it captures the accurate timing of the receipts, it reflects the true cost of investments, and it drives long-term financial health, because at the end you need to be able to pay your creditors, and you need to be able to pay your creditors using the money you receive from your debtors. So you make sure that whatever you invest in, it just can't be an accounting profit. You need hard cash. And the other reason why you don't really want to use profit is because profit includes items like depreciation, notional expenses, or income. It could also be the accounting principles may change, techniques may change. So to compare something apples to apples, let's say, it's not easy. It's not consistent. So cash is always consistent because it is when it happens and how much. So that's why we use cash. And when we talk about cash flow, essentially there are three types of cash flow, and the first one is the initial cash flow. This could just be items that are like your initial investment cost, the purchase of machinery, maybe the leasing of machinery. It could be land purchase cost, whatever. It's essentially the initial cash outflow that you are incurring to acquire whatever you need to acquire, like get the project running. What you don't generally kind of like take into account is any sunk cost or any existing any financial cost. So sunk costs are expenses that have already been incurred in the past that have no additional expense to be incurred will not be considered because it's not relevant. Once the cost is sunk, it's sunk. We really should be taking into any account. So the finance charges are usually excluded because in this it's under the financial domain, not in the investment domain. So we generally do not take into account any finance charges. Subsequent year cash flows usually include probably revenue, operational cost. There also might be a certain outflow in, let's say, year 5 or 10, like a repair cost or overhaul cost. Maybe that's there, but essentially it is all the working capital and the operational expenses and the revenue that occurs. Terminal cash flow probably is when it incurred when the project is winding down and you're closing everything, and probably the only expenses that you can look forward to is facilitating the sale of the machinery or disposal of assets, and any income from the salvage value would be considered. So this is really the kind of areas that we're going to look into. And so we actually, before we go into any capital budgeting technique, right, we spoke so much about cash flow, the importance of it. So it's important to kind of get one other concept in your head before you kind of go into what the capital budgeting techniques are, and it's called time value of money. So time value of money simply means that a rupee is worth more today than it is tomorrow, and there's no real hard-driven scientific logic behind it. It's probably a mix of human nature. You prefer having the cash in the hand than say an arbitrary amount in the future. If at all, you do agree to something like that, you want a certain security. Say someone's saying, you give me 1,000 rupees today, I'll give you 10,000 rupees in a year's time. You probably will want to make inquiries into how exactly they can generate that return, and whether it's a genuine return or if it's a scam. And so it's kind of like it's your cash is always much more valuable in your pocket than in somewhere else. So that's really the heart of the concept. But in addition to that, money can generate a return. For example, let's say you don't want to do anything with it, you could still put it as an FD in a bank. Even a savings account gives you 3%. Fixed deposit probably gives you 7% now. So that means even if you did nothing but just put an FD, your 100 rupees will become 107 at the end of the year. So that itself generates value. So if you are going to invest your money in something, then it should generate at least more than 107 rupees. Now this is not even taking into account inflation, which is another factor which you should keep in mind. So most FDs are really not, the real returns after inflation is probably 1 or 2%, because we have about 6%, 5.8 to 6% inflation right now. You get probably 7.2%. So what are you actually really getting as an interest return on your investments? About 1.2 in terms of real returns. So it's important when you analyze investments that you take into context the time value of money. And when, let's say, you're looking at future cash flows, that is cash flows you receive after year 1, 2, 3, 4, 5, like as in those years, let's say you receive, if you invest in a product of like 50,000 rupees, you're going to get 20,000 rupees in year 1, 30,000 in year 2, and 50,000 in year 3. Now that 50,000 in year 3 sounds great, but really what is the confidence that you have that you will get that money, and what is the value of that money in today's terms, right? That is really what you have to think of. And one way companies use the time value of money is to discount cash flows at the cost of capital rate. That is usually the return that they need to earn for their equity shareholders, and to arrive at the present value of money. So that's where this concept will come in. We'll probably explore this more when we look into something like net present value, but for now this is just a concept you need to know. Now we go into capital budgeting techniques and the overview of the different techniques. As you can see, there are two different schools of techniques. One is the non-discounted techniques and the other is the discounted cash flow techniques. So the non-discounted techniques, there's only one technique really that's a little bit of an outlier, but it is the average rate of return. Now that's the only technique that we are going to look into that uses profit as a metric of success. So essentially the ARR looks into the average annual profit divided by the average annual investment. Now it's an interesting metric, it's a financial metric, it's simple and easy to calculate, but besides giving you a basic ROI as vis-a-vis profit, it is not really a useful metric, especially because it does not consider cash flow and it does not consider time value of money. So the other three non-discounted techniques really come under the payback period. It's a set that there's one main measure and then there are two variations. Payback period essentially looks at the time taken to recover the initial investment. This is actually a useful way of thinking about it. Imagine you put 10 lakhs into investing in a project. That money has gone from your bank balance. You don't have it anymore. So it is definitely something a company or business will think, how quickly can I get that cash back? I spent 10 lakhs, my my cash balance is less by 10 lakhs, how quickly can I add that back to my cash balance? Because you don't want to be running on credit, you want to run the business on your own cash flows. So understanding the payback period is important. So imagine if for the 10 lakh project, in the first year you get about 2 lakhs, the next year you get about 6 lakhs, that's 8. And the third year, let's say you get about 5 lakhs. Between the second and third year, you essentially recover the amount you invested. So it is between 2 and 3 years. And just for easy sake, let's say we just get 5 lakhs and 5 lakhs in the next 2 years. So in 2 years, you recover the 10 lakhs back. 2 years is the payback period. So payback profitability, now one of the big issues we had with the payback period is that it stops at the point you recover the initial investment, right? What about after? Especially when you're looking at investment, it's not enough just to know how quickly you get your money back. It's how much value it can generate over the long run. That's also what we want to know. So payback profitability tries to look at that. Essentially, what it says is, what is the amount of cash flow is generated after recovery? That would be your profit. So any income above your expense essentially becomes your profit. So that's as simple as that. And the final thing is reciprocal. Payback reciprocal is a way to convert your payback period into a percentage. And to illustrate what that means, imagine you put a project that's 50,000 rupees, and you get, let's say, 20, 20, and 10 in the 3 years time. So it takes 3 years to get back your investment. So if you inverse that 1 by 3, in 3 years, 1 by 3, that's 33%. So that's the rate of return at which you are recovering your investment. And that helps you to compare. It gives you a percentage so that you can actually compare easily, as opposed to, let's say, years or any other way of looking at it. So those are the 3 payback measures. And with that, we come to an end with the non-discounted techniques. We move into the discounted cash flow techniques. Now this is really where the bulk of capital budgeting happens, and we're just going to see a quick overview today. So the net present value is the first technique. It's a very simple concept, although it can really get complicated once you get into it. The idea is that you have a series of cash inflows that happen across multiple years. You have a cash outflow in, let's say, the first year, or like year 0 as it's called, I think now, that's the present value. So you incur money today, you get money tomorrow, but you don't understand the exact value of that money you get in the future in today's terms. So what net present value says, or the NPV technique, which is essentially using a discounted cash flow methodology, says is, okay, take all the future value receipts, you discount it using a rate of return. It could be the risk-free rate, it could be the cost of capital, but you discount it and you bring it to the present rate. And with that, what happens is that you understand, okay, what is the true rate of, what is the actual value that you're adding in today's money. So the idea is to take these cash inflows that happen across a period of times, which are not equal, because if you factor in things like inflation, the time value of money, 10,000 in year 1 and 50,000 in year 5, they're actually not the same. Even though they look the same, they're not. So when you factor everything back into its present value, then you're able to do an apples to apples comparison. Simple, your present value of cash inflow minus present value of cash outflow gives you the net present value, or the excess or true return of the investment. That is the value, shareholder value, that is generated, that can be returned back to the shareholders. So NPV is essentially a measurement that uses discounted cash flow techniques to see, is this project adding more value? So that's NPV. Now the IRR is the next technique that we use. Its definition essentially is the discount rate at which the NPV becomes 0, or that is the present value of cash inflows equals the present value of cash outflows. Now, one of the challenges with using NPV is that you get an amount. For example, it will be something 25,000 is the present value of cash inflow and 10,000 is the present value of cash outflow. 15,000 is the NPV, the net present value. Now, if you have multiple projects like 15,000, 40,000, which one is better, right? You could of course take the one with the higher NPV, but the higher NPV one might also have a higher project cost. So how do you actually do an apples to apples comparison? And the IRR is a percentage. Because it's a percentage, it actually helps or makes it a lot easier to come up with the return. And so what the IRR tries to do is to try and what percentage or what cost of capital percentage. And there's no formula for this. It tries to find out when will the NPV become zero, the break-even point of the investment, and then you can take the IRR and compare it with your cost of capital. And if your IRR is higher than your cost of capital, it's a good investment to do. So and generally when the IRR is higher, it's always better. And finally, you have the profitability index. The profitability index essentially states that what is your per rupee return on your investment. So if your present value of cash outflows is 20,000 and the present value of cash inflows is 40,000, 40 by 20, that's you have a PI of 2. That means for every 1 rupee that you put, you get 2 rupees in return. So it's just one other way of looking at the rupee per rupee amount of revenue generated or value generated. So these are the techniques. Let's look at a few examples to kind of understand how exactly this happens. So here's a case study. If you have to buy a new equipment, so company A considers buying a new machine costing $10,000 with a 5-year lifespan and an annual cash flow of $3,000. So here's the thing: the payback period, if it's 10,000, 3,000, 3.3 years, you get your money back. NPV at a discount rate, it's actually generating a negative NPV, although IRR is 5.2%. Since the discount rate is 10%, and in this case, you can think of the discount rate as the cost of capital. That means your IRR is actually lower than your cost of capital, and you have a negative NPV. So this is not like a good project to kind of take up. Similarly, there's another way you can think of this. Expansion project. Company B evaluates opening a new store requiring initial investment of $20,000 with an expected annual cash flow of $5,000 for 10 years. The analysis: okay, if you're earning $5,000 per year, your investment is $20,000, you get your payback in 4 years. Net present value at cost of capital or discount rate of 8%, you get an NPV of 1,580, and your IRR is 12%. That's higher than the cost of capital. Hence, this is a project that you can accept. So this is how they're going to be using these techniques. In the future videos, we'll look more into each of these techniques and we'll look into solving problems. But this is like a quick overview So this is essentially some of the techniques of capital budgeting, the discounted cash flow, non-discounted cash flow techniques. Now that you know all these concepts, we can look at them in depth in later videos. Thank you for watching.